Welcome to this educational series on Whole Farm Revenue Protection, or WFRP. Throughout these videos, we'll explore what Whole Farm Revenue Protection is, who it was designed for, what it takes to apply, and how it differs from more traditional crop insurance products. By the end of this lesson, you should understand not only the purpose of WFRP, but also why it has become an increasingly valuable tool for diversified farming operations across the United States. So, what is Whole Farm Revenue Protection? Unlike traditional crop insurance that protects one commodity at a time, Whole Farm Revenue Protection covers the expected revenue of the entire farming operation under a single insurance policy. Whole Farm Revenue Protection is available in every county across the United States, making it one of the most widely accessible federal crop insurance products. Additionally, the program can cover essentially any sized operation, as farms with up to $17 million in insured revenue are allowed to participate. As many know, diversified farms often experience one enterprise performing well while another struggles. This program is particularly well suited for specialty crop operations, mixed crop and livestock farms, organic farms, and producers selling directly into local, regional, or identity-preserved markets. It's also valuable for operations where traditional single crop insurance products either don't exist or don't provide adequate protection. WFRP fills an important gap by offering insurance for operations that are too diverse for conventional policies. One of the factors that influences the premium subsidy a producer receives under Whole Farm Revenue Protection is the operation's commodity count. It's important to understand that commodity count is not simply the number of different crops or livestock raised on the farm. Instead, it's a calculation based on how diversified the farm's revenue actually is. To determine commodity count, the policy establishes a minimum revenue threshold that each commodity must meet before it can be counted. Think of it this way: simply producing a commodity isn't enough. The commodity must contribute a meaningful share of the farm's total revenue. For an operation where revenue is evenly distributed among all commodities, the minimum revenue contribution required for each commodity is 1/3 of that share. This rule prevents producers from artificially increasing their commodity count by adding very small enterprises that contribute little to the overall business. Imagine a diversified cattle operation that also grows hay to help offset feed costs. In the first scenario, cattle generate 95% of the farm's revenue, while hay contributes only 5%. Although the farm technically produces two different commodities, the hay enterprise represents such a small portion of the operation's revenue that it does not meet the minimum threshold required to count as a separate commodity under WFRP. As a result, this operation is considered to have one countable commodity. Now compare that to the second example. Here, cattle account for 80% of the revenue, while hay contributes 20%. Because the hay enterprise now represents a much larger share of the farm's revenue, it exceeds the minimum threshold required by the commodity count calculation. In this case, both cattle and hay are considered countable commodities, so the operation has two countable commodities. Commodity count depends on how much revenue each commodity contributes, not simply whether it is produced. As revenue becomes more evenly distributed across multiple enterprises, the operation becomes more diversified, which may qualify the producer for a higher premium subsidy under Whole Farm Revenue Protection. Operations producing only a single commodity can still participate in Whole Farm Revenue Protection. However, they generally receive the standard enterprise subsidy rate instead of the enhanced whole farm subsidy available to diversified operations. One of the primary goals of the program is to encourage farms to diversify their sources of income wherever practical. Although single commodity farms remain eligible, the greatest financial incentives are reserved for the operations with multiple revenue streams. As we know, producers that increase the number of commodities included in their operation gain additional premium discounts. This benefit is capped once the operation reaches 7 different commodities. After that point, adding additional commodities does not increase the subsidy premium any further. This structure rewards diversification while maintaining consistency across participating farms. Whole Farm Revenue Protection will cover your farm's commodities produced during the insurance period, whether they are sold immediately or remain in inventory. It also covers eligible commodities purchased for resale during the insurance year. The policy protects against revenue losses caused by unavoidable natural events that occurred during the insurance period as well. Examples include drought, excessive moisture, freeze, wildfire, and other natural causes. If these events reduce the farm's allowable revenue enough to fall below the insurance guarantee, an indemnity payment may be triggered. The policy also includes replant coverage for many annual crops. However, there are some exceptions. For example, industrial hemp and crops already insured under certain other federal crop insurance policies may not qualify for replant coverage under WFRP. Understanding both the covered causes of loss and any policy limitations is essential before purchasing coverage. Finally, it's just as important to understand what whole farm revenue protection does not insure. The policy does not cover timber or forest products, animals raised for sport, exhibition, or as pets. It also does not protect against losses resulting from poor management decisions, inadequate record keeping, or failure to comply with policy requirements. Perhaps most importantly, WFRP depends heavily on accurate financial documentation. Revenue must be supported by tax records, sales records, and other acceptable documentation. Without verifiable records, determining approved revenue or calculating an indemnity is impossible. Good record keeping isn't simply recommended under whole farm revenue protection, it is one of the foundations of the entire program.